Imagine waking up, grabbing your morning coffee, maybe expecting a quiet start to the day.
Mm-hmm.
You open your phone to check the markets, and you see that one of the world's oldest, most trusted forms of money has just plummeted 17%.
Right. In practically the blink of an eye.
We are talking about silver in early February 2026. It's trading around, what, $72 an ounce right now?
Which, if you just woke up from a 2-year coma, sounds incredible.
Mm.
But if you've been awake for the last month,
Oh, it feels like a disaster.
it really does.
Exactly. It feels like you were strapped to a rocket that just suddenly ran out of fuel in the stratosphere. And what makes it even weirder is if you looked at gold on that exact same day.
Yeah.
Gold is usually silver's big, boring brother, right?
Usually, yes. They tend to move in the same direction. But on this day,
Not at all.
gold was the picture of calm. It was down maybe 2%. It barely flinched.
Meanwhile, silver was essentially jumping off a cliff without a parachute. And that is the mystery we are tackling today. Why is silver acting like a volatile meme stock or, a crypto token, while gold is acting like, well, gold?
Right.
We are doing a deep dive into the structural market factors causing all this chaos. And to guide us, we have a fascinating report. It's titled Current Silver versus Gold Volatility Comparison.
By financial markets researcher Doug Young, published just recently, February 9, 2026.
And it is a great source for this.
And what I love about this report and why I think it's perfect for a deep dive is that it doesn't just scream panic or manipulation, which is what you usually see.
Oh yeah, all over the message boards.
Doug Young, he looks under the hood. He argues that this volatility isn't just random noise, it's actually a result of the physics of the market.
The physics.
We're talking about liquidity, geological reality, and the weird dual personality that silver has.
Okay, let's unpack this, because before we get to the physics and the geology, we have to look at the crime scene. We need to establish just how wild this ride has been, because the crash didn't happen in a vacuum. It wasn't exactly quiet before the drop, was it?
No, not at all. You really can't understand the fall without understanding the climb.
Okay.
If we rewind the clock just a little bit to January 2025, silver was sitting at roughly $30 an ounce.
Which, looking back, feels incredibly cheap.
It does now. But then, fast forward exactly 1 year to January 2026, silver hit a peak of $121.64.
Wait, hold on. I want to make sure the listener really hears that. $30 to $121.
Yeah.
That is, let me check my math here. That's a 293% increase.
In a single year.
That's massive.
It is. That's nearly a 3x return. I mean, that is the kind of return you usually chase in high-risk tech stocks or venture capital, not in a major global commodity.
So the market was already overheated.
It was priced for absolute perfection, and then gravity kicked in.
And when it kicked in, it didn't just correct, it crashed.
Right. The report highlights one specific day that will probably go down in history, January 31st, 2026.
The day the floor fell out.
On that single trading session, silver dropped 27.5%.
Wow. A 27.5% drop in a day isn't a market correction, that's a catastrophe if you're holding the bag.
Oh, yeah.
If that happens to the S&P 500, they shut down the stock exchange.
Precisely. And Doug Young's research points out that January 2026 wasn't just about that one bad day, so to speak.
Okay.
The month saw 9 days of what they classify as extreme volatility.
9 days.
To put that in perspective, that matches the total number of extreme volatility days for the entire year of 2025.
So we basically crammed a year's worth of panic and chaos into 4 weeks.
We did.
And now, as of early February, we are hovering between $74 and $78. So we've had a partial recovery, but the chart looks broken.
It does.
So here's the big question, the one I think everyone is asking.
Yeah.
Why didn't the supply side save the day?
Right.
Basic economics, right?
Yeah.
If donuts go to $100 a pop, I'm opening a bakery.
Okay.
If silver goes to $121, why aren't the miners digging up every ounce they can find?
Yeah. That is the logical assumption. High prices trigger more supply, which brings prices down. That's how it works for oil, for wheat, for sneakers.
But not silver.
But silver is geologically frustrating. The report emphasizes this concept of inelasticity.
Inelasticity, meaning the supply doesn't stretch or react when prices pull on it.
Exactly. It can't. And here is the killer stat from the report that explains why.
Okay.
Approximately 67% of all silver comes out of the ground as a byproduct.
A byproduct, you mean they aren't even looking for it?
Mostly no. They are mining for copper, zinc, or lead. The silver is just the bonus metal found in the ore.
Okay, so let's play this out. Imagine I'm the CEO of a massive global copper mining company. Silver prices triple. Am I not excited?
You're happy, sure. It's a nice tip. It lowers your overall costs.
Mhm.
But think about your operation.
Uh-huh.
Your crushers, your chemical flotation tanks, your 50-year mine plan. It's all engineered specifically for the copper ore body. If silver skyrockets, you aren't going to spend $5 billion sinking a new shaft just to chase a silver vein if the copper demand isn't there.
Because you're a copper company. You answer to the copper market.
Correct. You are beholden to the base metal. This makes the silver supply structurally slow.
It can't flip a switch.
It literally cannot. So when demand surges, like it did throughout 2025, you get these persistent supply deficits. The price screams higher, begging for more metal.
But the miners are just shrugging.
The geology and the mining economics just shrug and say, sorry, we're busy mining zinc.
That is frustratingly fascinating. It's like the tail trying to wag the dog. The dog is copper and it goes where it wants.
That's a perfect analogy.
So the supply side is basically stuck in traffic. But clearly something was driving that price to $121.
Oh, yeah.
If supply was stuck, the demand must have been absolutely ferocious. Who was buying all this silver at triple-digit prices?
Oh, it was ferocious. And this brings us to the second pillar of the report, the industrial demand pressure cooker. We aren't just talking about people buying silver coins for their safes. We are talking about massive global industries that literally cannot function without silver.
Right. I know silver is the most conductive element, but what are the big drivers here?
The biggest one is the solar PV boom, photovoltaic cells.
Okay.
The forecast for 2026 is that global solar capacity will reach 665 gigawatts.
665 gigawatts. That sounds like a lot, but translate that into silver for me.
That level of solar production consumes about 120 to 125 million ounces of silver.
Wow. Okay, just for solar panels.
Just for solar. And then you have the electric vehicle revolution.
Right.
EVs use significantly more silver than internal combustion cars for the electronics, the battery management systems, the screens, everything.
So how much is that?
The projection is 14 to 15 million EV units in 2026. That adds another 70 to 75 million ounces of demand.
So between solar and EVs, we are talking about nearly 200 million ounces.
Right.
And that's before we even talk about grid upgrades or data centers.
Exactly. Infrastructure and data centers take another 15 to 20 million ounces. But here is the critical part, and it connects back to that word inelasticity.
Got you?
This time on the buy side.
Meaning they will buy it no matter the price.
Yes. Think about it. If you are manufacturing a Tesla or a commercial solar farm, silver is a tiny fraction of your total cost, maybe less than 1%.
But it's essential.
It's absolutely essential. You can't build the product without it.
So if silver goes from $30 to $100, you don't stop building cars.
You grumble, you maybe hedge, you fire your procurement guy, but you pay the price. You have to. This puts a floor under demand.
So we have a supply side that can't produce more and a demand side that won't stop buying.
Yep.
That is the recipe for a price explosion.
It is. It's a classic squeeze. But that explains the rally up to $121. It doesn't fully explain the crash down to $72.
Right, because the solar factories didn't just shut down on January 31st.
Exactly. To understand the crash, we have to look at the market structure itself, the financial plumbing.
The report calls this the small pond effect.
Right. And this is one of my favorite comparisons in the report because it really visualizes the difference between silver and gold.
Yeah. The report mentions the float disparity. Can you break that down for us?
The float is essentially the amount of the asset available for trading.
Okay.
Doug Young notes that silver's investable float in dollar terms is roughly 165th the size of gold's.
Well, it's 65th. That is tiny.
It's microscopic in financial terms. I mean, it's a rounding error compared to the bond market or even the gold market.
So if I can use an analogy here, gold is like a massive cruise ship in the middle of the ocean.
Uh-huh.
You can have a huge party on one side of the deck, millions of dollars flowing in, and the ship barely tilts.
Exactly. It's stable. It absorbs the wave.
And silver is like a canoe.
A canoe is probably perfect. If that same group of people tries to jump into the canoe, meaning if the same amount of money tries to flow into the silver market,
The canoe flips over.
it flips over. The door is too small.
So when big institutional money decides, hey, let's get into silver, the price skyrockets because there's just nowhere for the money to go.
And conversely, and this is what happened in January, when they decide to leave.
The exit door is tiny.
The exit door is tiny. Everyone gets crushed on the way out. The report calls this thin liquidity. It means institutional flows dominate price discovery. When the big whales move, the water goes everywhere.
Okay, so we have the fundamental setup, tight supply, desperate demand, and a tiny market. But a setup isn't a trigger.
No.
What actually caused the bottom to fall out in late January? Why did everyone run for the exit at the same time?
Oh, this is where we get into the mechanics of the crash. It wasn't necessarily that people stopped needing solar panels. It was about the futures market and the CME, the Chicago Mercantile Exchange.
The referees of the market.
In a sense, yeah. Their job is to keep the market solvent. When volatility gets too crazy, the CME steps in to ensure people can pay their debts.
And they do this by raising margins.
Yeah.
And for listeners who aren't day trading, margin is basically the down payment you have to put up to hold a contract, right?
That's it.
You aren't buying the silver outright with cash?
Correct. You are using leverage. You put up a deposit. In late 2025 and early 2026, as prices were whipping around, the CME raised the initial margin requirement significantly.
How much?
It went up to $25,000 per 5,000-ounce contract.
$25,000 per contract. That's a steep ticket price.
It was about 9% of the total value at the time. Now, that might sound prudent for the exchange, but think about the trader.
Right.
Imagine you are holding a lot of silver contracts on leverage. Suddenly, the exchange taps you on the shoulder and says, "We need more cash from you right now."
And if you don't have the cash?
You have to sell. You are forced to liquidate your position to cover the margin. And when you sell, what happens to the price?
It drops.
And when the price drops, the trader standing next to you gets a margin call because his position is now losing money.
So he has to sell.
He has to sell. It's a domino effect.
A chain reaction.
We call it a liquidation cascade. And remember, in the futures market, paper contracts outnumber physical delivery by a huge amount. So you have all these paper bets unwinding at light speed.
And the stop losses get hit.
Stop loss triggers get hit, which are automated sell orders, and the computers just dump everything.
So the crash wasn't because solar factories stopped working. It was because the financial structure of the market, the leverage, the margins, it forced a sell-off.
Precisely. Leverage amplifies everything. It made the run-up to $121 faster than it probably should have been. That was the gamma squeeze on the way up.
And on the way down.
And it made the drop to $72 feel like a car crash. The move feels deeper and faster than the physical reality of supply and demand would suggest.
That really clarifies the difference between the paper price and the actual metal. It seems like silver has a bit of an identity crisis.
It really does. And this is the synthesis point of the whole report. Silver is two things at once.
Okay.
On one hand, it is an industrial metal like copper or iron. It's driven by the solar and EV needs we talked about.
All right, the I need this to build stuff asset.
But on the other hand, it's a monetary asset. It's poor man's gold.
A hedge.
It's a hedge against inflation. It's driven by investors and speculation.
So you have two completely different groups of people playing in the same sandbox.
And they have conflicting goals. The industrial buyers just want stability so they can plan their production.
Sure.
The monetary investors are chasing momentum and fleeing inflation. When you combine those diverse participants with that tiny canoe-sized market we mentioned,
You get chaos.
you get what the report calls volatility clustering.
Volatility clustering. It sounds like a weather phenomenon.
It basically is. It means periods of calm followed by periods of absolute storms. And that is what we saw in January 2026.
So here's where it gets really interesting. What does this all mean for us? If we step back and look at the 17% crash and the 2% drop in gold, it feels like a warning. But maybe it's just the nature of the beast.
That's the takeaway. The report concludes that while the volatility is scary, terrifying, even if you're watching the charts minute by minute, the underlying story hasn't actually changed.
The solar panels still need to be built.
Right. The supply tightness, that byproduct issue, is still there. The miners didn't magically find a new continent full of silver.
And the EV demand is still there.
The demand from the green energy transition is still there. The volatility provides context. It tells us about the structure of the market, the leverage, the liquidity. But it is not a crystal ball for the future price.
It just tells you that the ride is going to be bumpy.
Very bumpy.
It's a perfect storm. You have inelastic supply because miners can't just pivot. You have inelastic demand because industry needs the metal.
Yeah.
You have a tiny market size 165th of gold.
Yeah.
And then you have the futures market pouring gasoline on the fire with margin hikes.
That sums it up perfectly. It explains why we saw a 293% rise and a 27.5% single-day drop. It's the mechanics of a squeezed, leveraged, essential market.
It really makes you think about the disconnect between the screen and reality. I mean, here's a provocative thought to leave you with.
Okay.
We just watched the paper market crash 27% because of margin rules and financial plumbing.
Right.
But meanwhile, somewhere in a factory in Shanghai or Berlin, A production line is still churning out solar panels that need 125 million ounces of physical silver.
And they can't print it?
They can't print more silver. They can't issue shares of silver. They have to find the actual atoms. So if the paper price crashes but the physical need remains, how long can the price stay down before reality forces it back up?
That's the question.
It's a battle between the casino and the factory. And usually, eventually, the factory wins.
That is the billion-dollar question. The disconnect can last a while. The casino is loud, but it can't last forever.
Well, that is all the time we have for this deep dive. Hopefully, next time you see a headline about silver crashing or skyrocketing, you'll picture that canoe in the ocean and nod your head.
It's always about the structure underneath the price.
Thanks for listening, everyone. Catch you on the next one.
Goodbye.